DGRO is the iShares Core Dividend Growth ETF. It is built for long-term investors who want dividend growth, not just high yield. That means instead of chasing stocks that already pay a huge dividend, DGRO focuses on companies that consistently grow their dividend every single year. It's for investors who want rising income over time. DGRO tracks the Morningstar US Dividend Growth Index, which only includes companies that have consistently raised their dividend for at least 5 years in a row. In other words, these are dividend growers, not just dividend payers. As of 2025, the fund holds over 400 companies. The biggest names include Microsoft, Apple, Johnson & Johnson, JP Morgan Chase, and United Health. These are large blue-chip stocks with strong balance sheets and a proven history of rewarding shareholders. Let us talk about how the index works. To be included, a company must meet strict rules. First, it must have 5 consecutive years of uninterrupted dividend growth. Second, it must have a payout ratio below 75%. That means the company is not giving away more than 3/4 of its earnings as dividends. This ensures the dividend is sustainable. Third, REITs are excluded. That means no real estate investment trusts are allowed in the fund. This gives it a cleaner profile focused on traditional operating companies. Fourth, the index is rebalanced and reconstituted annually. So every year, new companies that meet the criteria are added, and those that fail to meet the rules are removed. The goal is long-term dividend reliability and growth. Now let us talk performance. DGRO has delivered strong total returns over time. The average annual return over the past 5 years has been around 10 to 12% per year. That includes both price appreciation and dividend income. The current dividend yield is around 2.4%. That may not sound high, but remember the key here is growth. The dividend payout has been increasing each year. Over the last 5 years, the average dividend growth rate for DGRO has been over 10% per year. That means your income is compounding. You may start with 2% today, but in 10 years, it can feel like 5% or more on your original investment. That is the power of dividend growth. Now let us talk about fees. The expense ratio is just 0.08%. That means for every $10,000 invested, you only pay $8 per year. That is one of the lowest fees you will find for any dividend ETF. It is extremely cost-effective and efficient. In terms of diversification, DGRO holds over 400 stocks across all 11 sectors. The biggest sector weights are information technology, healthcare, financials, consumer staples, and industrials. It is broadly diversified, but still tilted toward large-cap blue-chip names. Now let us look at income examples. 100 shares of DGRO currently yield around $70 per year in dividends. 500 shares pays around $350 annually. 1,000 shares earns about $700 per year. That is assuming a current share price near $40 and a 2.4% yield. But remember, the dividend is growing. If it increases 10% each year, your income will double in 7 years and quadruple in 15. That means with time and reinvestment, DGRO becomes more and more powerful. It is ideal for dividend reinvestment plans, also known as DRIPs. You earn dividends and immediately reinvest them into more shares. This snowballs your growth over decades. Let us compare DGRO to other popular dividend ETFs. Versus SCHD, DGRO is more diversified and lower yield. SCHD focuses on 100 stocks and tilts more toward high yield. DGRO is broader and favors growth. Versus VIG, the Vanguard Dividend Appreciation ETF, DGRO is very similar. Both focus on dividend growth, but DGRO includes more companies and offers a slightly higher yield. Versus high-yield ETFs like JEPI or QYLD, DGRO pays less income today but offers far more growth potential. High-yield ETFs often suffer from declining NAV. DGRO grows in value over time, making it better for long-term investors. Let us talk risk. DGRO is relatively low risk for a stock ETF. It holds strong companies with reliable earnings and conservative payout ratios. It is less volatile than the S&P 500, especially during market drawdowns. It will still lose value in a bear market, but the dividend income helps smooth the ride. Let us score DGRO on my meter rating. Income gets a 6 out of 10. It is not high, but it is consistent. Growth potential scores a 9 out of 10 thanks to the compounding effect of dividend increases. Risk management gets a 9 out of 10 due to the strict criteria and low volatility. Sustainability scores a 10 out of 10. These companies have a long history of dividend discipline. Simplicity scores a 9 out of 10. It is easy to understand and cheap to own. Overall, I give DGRO a solid 9 out of 10. This is one of the best ETFs for building long-term wealth through rising income. It is not flashy, it is not high yield, but it works. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.